Imagine an ETF that pays 28% dividend yield distributed weekly. It sounds too good to be true, but over $600 million of investor money has already poured into this fund. The Roundhill QDT ETF employs a sophisticated options strategy called the poor man's covered call that most retail investors haven't discovered yet. I recently spoke with an investor who was shocked when dividends appeared in his account every Friday, completely transforming his perspective on passive income. Today I'm showing you exactly how this strategy works, the risks that aren't being discussed, and whether this could actually replace your 9-to-5 income. Did you know the average American earns just $56,000 per year from their full-time job? Now imagine having investments that generate that same income without you having to work at all. Sounds like a dream, right? But for many people pursuing financial independence, this dream feels impossibly out of reach. Let's talk about why most people feel trapped in the 9-to-5 grind. The majority of Americans are stuck trading their precious time for money, working over 40 hours weekly with minimal flexibility. Your income potential has a fixed ceiling determined by someone else, while your time freedom practically disappears. Think about how many people you know who are caught in this cycle, working jobs they don't love simply because they need the paycheck, missing important life moments because they can't step away from their desks. This frustration multiplies when examining traditional investment options. Standard investments like bonds, CDs, or dividend aristocrats typically yield between 2 and 4% annually. The math becomes discouraging quickly. Replacing that $56,000 salary requires a staggering $1.4 million invested at a 4% yield. For most Americans with modest savings, accumulating that capital seems nearly impossible. The economic landscape makes this challenge even harder. Inflation continues eroding our purchasing power, while wages have remained largely stagnant for decades. Today's dollars buy less than they did just a few years ago, making it increasingly difficult to break free from the paycheck-to-paycheck cycle, keeping so many people locked into unfulfilling jobs. This creates what I call the wealth-building paradox. You need to work to earn money, but the time spent working prevents you from focusing on building wealth through other means. You're caught in a system where your livelihood also ensures you remain dependent on it. Most people simply lack enough hours to both earn their primary income and develop secondary income streams that could eventually set them free. Many investors turn to dividend investing as a potential escape route, since dividend stocks provide regular, passive income without selling assets. But here's the problem. Truly high-yield dividend options, those paying 10% or more, often come with substantial risks. Financial advisors call many of these dividend traps, investments with eye-catching yields secretly eroding your principal, essentially returning your own money bit by bit. But what if there were an alternative that upends conventional investment math? This is where QDT's approach represents something genuinely different. Instead of typical 2 to 4% yields, or even risky 10% yield, QDT offers something remarkable: a 28% yield distributed to investors weekly. This completely transforms the financial independence equation. With a yield this high, you'd theoretically need just $200,000 invested to generate that same $56,000 annual income. Suddenly, replacing your salary with investment income doesn't require millionaire status. Financial independence comes within reach for many more Americans who've managed to save a moderate nest egg. Think about what this could mean for your life. Instead of spending 40-plus hours weekly at a job, your investments could work around the clock, generating income for you. Imagine waking up every Friday to a fresh dividend payment hitting your account. Not quarterly or monthly, but every single week. That's the potential reality QDT offers. Those weekly payments hitting your account every Friday morning sound incredible. But here's what's fascinating. QDT doesn't actually own a single share of stock. That's right. Behind that impressive yield lies a strategy so different from traditional dividend investing that it completely transforms how income generation works in the investment world. QDT employs what professional traders call a poor man's covered call strategy. This sophisticated options approach mimics traditional covered calls, but with a crucial difference. It requires significantly less capital. Imagine having two identical houses. One cost $500,000 to buy outright, while the other gives you similar ownership benefits for just $50,000 down. That's the financial efficiency we're talking about. Most investors avoid option strategies because the terminology, strikes, expiration dates, calls, puts, feels like a foreign language. This knowledge gap prevents many from accessing higher yields, leaving these strategies to professionals. How does QDT's strategy work? Instead of purchasing stocks directly, the fund buys LEAPs, long-term equity anticipation securities. These are long-dated call options on the NASDAQ 100 index that don't expire for years. They function as stock substitutes that give similar market exposure at a fraction of the cost. QDT specifically purchases deep-in-the-money LEAPs with strike prices well below where the NASDAQ 100 currently trades. This positioning gives these options a delta close to 1, meaning they mirror the index movements closely. Think of it as having a miniature version of the entire NASDAQ 100 that moves in sync with the real thing, but cost much less to own. To minimize time decay, the natural erosion of option value, QDT holds 3 different sets of LEAPs expiring in 2025. This strategic positioning maintains market exposure while reducing the negative effects that time has on options. Here's where the income generation happens. Every trading day, QDT sells 0 DTE call options, options expiring that same day, against their LEAPs positions. By collecting these daily premiums, QDT generates the income that becomes your weekly dividend payment. This daily approach represents a significant advantage over traditional covered call ETFs that typically sell monthly options. Traditional funds lock in their income at the beginning of each month, potentially missing opportunities when market volatility increases mid-month. QDT capitalizes on daily market movements. When volatility spikes, during unexpected economic announcements or market turbulence, option premiums increase. By selling options daily rather than monthly, QDT can capture more premium during these volatile periods, maximizing potential income for shareholders. For those familiar with options terminology, QDT's strategy requires careful management of delta, theta, and vega, measures of how option prices respond to changes in underlying asset price, time, and volatility. The fund managers must balance these factors daily to maintain the strategy's effectiveness. What makes this revolutionary is how QDT packages this sophisticated approach into a simple ETF. You don't need to learn options trading or understand the Greeks. You're essentially hiring a team of options traders who execute daily trades on your behalf, collect the premiums, and deposit them into your account weekly. The complexity happens behind the scenes while you collect the distributions, giving you access to professional-level strategies without the professional-level effort. Those weekly deposits aren't just convenient. They're mathematically superior to traditional quarterly dividends in ways that could dramatically accelerate your journey to financial independence. The compounding advantage created by QDT's weekly payment structure adds a powerful dimension to your investment returns that most investors completely overlook. Imagine checking your investment account every Friday morning to find fresh dividend payments waiting for you. These regular deposits create positive reinforcement that transforms your relationship with investing. During market downturns, when many investors panic and sell at the worst possible time, those consistent weekly payments provide a psychological anchor. While others might abandon their investment strategy, you'll stay focused on the steady stream of income hitting your account, helping you maintain disciplined investing habits through volatility. For those approaching retirement or seeking financial independence, the weekly structure aligns perfectly with real-life expenses. Most of us pay bills weekly or bi-weekly, not monthly or quarterly. Having investment income that mirrors your actual spending patterns eliminates the need for complex budgeting systems or excessive cash reserves. With weekend distributions, you can maintain a much smaller cash buffer, keeping more of your money working for you in the market. Think of it like watering a plant. Traditional quarterly dividends are like giving your financial garden a heavy soak once every 3 months. Weekly payments are like providing a consistent, gentle watering every week. The plant grows steadily, continuously, and often more robustly than with sporadic drenching. Here's where the mathematical advantage becomes clear. When you receive dividends weekly rather than quarterly, you're creating 52 distinct compounding opportunities every year instead of just 4. Let me show you the impact with real numbers. If you invested $10,000 at a 28% annual rate, weekly compounding would yield approximately $14,000 over a year, while quarterly compounding would only generate about $12,500. That's a $1,500 difference, or 15% more money simply by changing the frequency of compounding. This compounding advantage creates a snowball effect that can potentially shave years off your journey to financial independence. Each weekly dividend payment can be immediately reinvested, generating additional income that itself begins compounding. It's like having 52 small snowballs growing simultaneously rather than 4 larger ones. The weekly payment structure also enables more effective dollar-cost averaging when reinvesting. Rather than making 4 large reinvestment purchases per year, you're making 52 smaller ones, smoothing out your entry points and potentially reducing risk. This methodical approach to reinvestment can be particularly valuable in volatile markets. If you received a quarterly dividend right before a market dip, you'd reinvest everything at that higher price. With weekly payments, only a small portion of your annual dividends would be affected, with subsequent weeks allowing you to invest at potentially better prices. Even for investors who use the income for living expenses, the weekly structure provides invaluable predictability. Having a reliable payment every Friday creates a financial rhythm that closely mimics receiving a regular paycheck, without trading your time for money. Beneath the glossy promise of weekly checks lies a hidden risk few will warn you about. What happens to your investment principal while those generous 28% dividends flow in? The answer might shock you. QDT's net asset value has already fallen by nearly 10% since inception, suggesting you might be unknowingly consuming your own investment capital with each dividend payment. This creates a troubling scenario where your bank account grows from weekly deposits while your actual investment base silently erodes. It's like watching money trickle out of a leaky bucket while you focus only on the inflow. Technically, you're receiving cash, but you're not actually getting richer. This phenomenon is particularly dangerous because it creates the illusion of successful investing. You're seeing regular deposits hit your account every Friday, but underneath that apparent success, your principal investment is quietly shrinking. This risk is compounded by QDT's expense structure, which further impacts your real returns. The fund charges a substantial 1% expense ratio, significantly higher than what you'd pay for most traditional index ETFs. This additional cost creates another drag on performance that compounds over time, further diluting the apparent benefits of that impressive 28% headline yield. Even more concerning is the fundamental issue of QDT's approach. When you invest in this fund, you're essentially handing your money over to fund managers who operate more like day traders than traditional investment managers. Their daily options trading decisions determine your returns, introducing a level of dependency on active management that most passive income seekers aren't fully aware of. This strategy comes with specific vulnerabilities that aren't immediately obvious. During periods of gradual market decline without significant volatility spikes, QDT offers surprisingly little downside protection. The fund's options strategy works best in choppy, highly volatile markets, but in steady downtrends, you may find yourself experiencing larger losses than expected while still being capped on potential upside. The zero DTE, 0 days to expiration approach creates another potential pitfall. When the fund sells options that expire the same day, it can inadvertently lock itself out of market recoveries. Imagine a scenario where the market drops in the morning, QDT sells its options, then the market suddenly reverses course in the afternoon. While traditional investors would benefit from this upswing, QDT might be stuck in positions that prevent it from capturing that recovery. There's also a tax consideration worth examining. For investors holding QDT in taxable accounts, those frequent distributions can create a higher tax burden compared to more tax-efficient investment approaches. For example, a 28% yield might translate to just 8 to 20% after taxes, depending on your tax bracket, significantly reducing your effective returns when Uncle Sam takes his cut. What we're discovering is that QDT isn't necessarily designed as a complete income replacement solution. Its strategy is specialized, working exceptionally well under specific market conditions, but potentially underperforming during sustained bull runs or gradual declines. This makes it more of a specialized tool than a comprehensive solution for replacing your full-time job. Consider QDT's strategy like specialized equipment rather than an all-purpose machine. Just as you wouldn't use a power drill to hammer a nail, QDT isn't designed to perform optimally in all market environments. Its effectiveness is largely dependent on market volatility. It thrives when markets swing wildly, but may struggle when markets move in steady direction. So I've shown you how QDT might seem like a ticket to financial freedom, but here's the part most YouTubers won't tell you. Financial experts recommend limiting high-yield investments like QDT to just 10 to 15% of your portfolio. Why? Because these attractive yields come with significant risks. Think of QDT as a powerful engine, impressive, but just one component in your investment machine. Consider starting with a small 5% position in QDT to experience those weekly payments while monitoring NAV stability. The path to replacing your job income requires a resilient portfolio that performs across various economic cycles. QDT might be valuable, but financial security isn't built on a single strategy. Maintain a diversified core of investments that can weather different market conditions. Master your financial journey by using specialized tools like QDT judiciously than a balanced, diversified portfolio.